bulk of Chapter 2 is really concerned with this primary question I'm writing down now. How do product costs flow through a company? When I say through a company, I mean through the financial statements, of course, but how do the product costs, not period costs, we know that hits the income statement, but how do product costs flow through? So as a lead-in for the chapter, let's look at what happens in a merchandising company. And recall, a merchandising company is your typical Best Buy. They buy stuff, put it on the shelf, you pick it up, you walk out with it, right? So Best Buy purchases stuff that's already completed. So they have purchases. And these boxes come in, and as they come in, they're logged into inventory. They have to go into inventory first. Notice now that they end up in inventory, which is an asset account. We don't take the purchase order and then automatically enter it onto the income statement. It has to pass through the inventory account. Once it's sold, it gets recorded as a sale and the corresponding cost of goods sold associated with that. I think that's pretty easy to get your head around, is the purchases flow into the company onto the balance sheet first. And remember, the matching principle says we want to match costs and revenues in the period incurred. So we may buy something in January but only sell it in March. We will only recognize the cost of that sale in March, even though we paid for it in January, because in the meantime it sits on the balance sheet. So it might be helpful to look at the type of journal entries that happen when this occurs. So when we have purchases, we debit inventory. That's the first account it goes in. We increase the value of inventory, and we increase the amount in accounts payable. Notice that neither one of these two accounts are an income statement account. They're both balance sheet accounts. Income statement is unaffected. Now, when we sell something, we record an accounts receivable and the appropriate sale for the amount. There's the first journal entry to record the sale. The second journal entry will record the cost of goods sold. So we will record cost of goods sold, whatever it cost, and we will reduce the amount of inventory. Notice that when we move to the income statement, this is where we're moving the cost of the purchase off the balance sheet onto the income statement. So I think that's fairly straightforward. So let's have a look at a quick and dirty way to get our cost of goods sold based on just inventory amounts. So let's take our inventory, our beginning balance at the beginning of the period, whatever period we're looking at, and we'll record that. To that, we will add all our purchases, everything that we bought during that period of time. So we start with our beginning inventory balances, we add our purchases. That should give us how much inventory during the period we had available for sale. I think that's straightforward. What we started with and everything we bought, that's what we have available for sale. Well, we want to figure out how much we sold. So from available for sale, how much we sold? Well, we sold everything except what we have left. So we'll take off our ending inventory, off of everything that we had available, subtract what we have left, our ending inventory. That should then leave us with our cost of goods sold. Now, in a merchandising company, they don't quite figure it out this way, but in a manufacturing company, we're going to see that this becomes a very important process. So pay attention there. To help solidify it in your head, I'm going to give you an interesting example using beer. Let's say it's Friday night, and you get home from a hard day of whatever it was you were doing. You open the fridge, and what do you find in that fridge? You find 12 beer. 12 beers, 12 beer. Beer is already plural, but I'll throw the S on. You find 12 beers. During the day Saturday, you go out and you buy another 24, another case of beer. So you've been drinking Friday, you continue to drink Saturday, you continue to drink Sunday, and Monday morning, you wake up and open the fridge. And you're going to count how many beer you have left, and we find that we have 6 left. So the question then becomes, how many did you drink? Let's write that question down. How many did you drink? Now, this question is the same as what were the cost of goods sold. How many did you drink? So let's go through and see how this beer problem is an inventory problem. So Friday night, we started with 12 beer. That was our beginning inventory on beer, was 12. That was our beginning inventory. On Saturday, we went out and we purchased 24. So we add our purchases to our beginning inventory. That tells us that we had, over the course of the weekend, available to us 36 beer. In other words, with the 12 we had and the 24 we bought, we could have drank up to 36 beer. We wake up Monday morning and we find that we have 6 left. Well, 6 is our ending inventory, isn't it? That's the same as our ending inventory. We have 6 left. So if we had 36 available and we have 6 left, we must have drank 30. So that's equivalent to our cost of goods sold. Every inventory problem can be broken down into a beer problem. So let's move on now to a manufacturing company. Now that we've got the merchandising company, we'll do the manufacturing company. The manufacturing company is a little bit more complex because we do not have just one inventory account. We have 3. And let's see how this works. We still start with purchases. If we're a manufacturing company, we start with purchases. But what are we purchasing as a manufacturing company? We're purchasing raw materials because we make stuff. So we're purchasing the very units that go into what we're making. So they'll flow into something called the raw materials inventory. Now, as we use the raw materials, we take it out of the raw materials warehouse and we start working on it. We call that, believe it or not, work in process. It's no longer sitting in the raw materials inventory. It's now sitting in work in process inventory. This is all the product that we're working on that's not a raw material yet, but not quite complete. It's work in process. So the raw materials flow into work in process. But you'll recall from part 1 of this chapter when we discussed manufacturing costs, there were 3 of them. We have materials, we have direct labor, so our direct labor has to flow into our work in process account, and we have manufacturing overhead. This work in process account causes a lot of students a lot of grief because it's not just purchases. We have 3 inputs into the work in process inventory. Count the arrows. 1, 2, 3 arrows. Now, once the work in process is done, once we have a finished product at the end, it flows out into something called the finished goods inventory, which is the same as a merchandising company. So the finished goods inventory. From the finished goods inventory, we can make sales. And let's make a note of that. We can make sales. And obviously, this is where we would then record our cost of goods sold. And now we're on the income statement. We haven't hit the income statement until now. Now, when we send something from work in process to finished goods inventory, that is called cost of goods manufactured. Do not confuse cost of goods sold with cost of goods manufactured. Cost of goods manufactured flows out of work in process into finished goods. Cost of goods sold flow out of finished goods onto the income statement. Exactly. So we're going to we're going to sort of show the adjustments all the way down from purchases right to cost of goods sold, how we figured out everything. Notice that all of these are balance sheet accounts. In other words, from the time we buy something, it starts on the balance sheet. It does not leave the balance sheet until it is sold. So let's remember our beer example, and we're going to go through each of these accounts, and I'm going to show you how to develop the schedule of cost of goods manufactured. Well, the first thing we have to do is figure out how much raw materials we used, because that's one of the inputs into work in process, right? So let's start with our raw materials beginning balance, our beginning inventory balance. To that, we will add our purchases. Remember, we start with 12 beer. We add another 24 beer because we went out and bought it. So we start with our beginning balance of inventory. We add our purchases. That, total those two, will tell us how much of raw material inventory we had available. From that, we have raw materials left. So we'll subtract our raw material inventory ending balance. We'll subtract that ending balance. And that will give us the amount of raw materials we used in production. Now, this is important. We need this because look at that work in process account. It requires 1, 2, 3 inputs to figure out how much we had available. So this is step 1, is figure out how much raw materials we used by doing a balancing off of the inventory accounts for raw materials. Step 2, move over to the work in process account and do the same thing. Work in process inventory, beginning balance. What did we begin the period with? Add that. To that, we will add, now normally we add purchases, but we're not adding purchases here. Look at the inputs. We have 3 inputs, so we have to add 3 things. We have to add our raw materials used, which we just figured out up there. That's why we have to do that first. We add that. We have to add our direct labor, and typically that will be given to us. We'll pretty much know what our direct labor number is, but we have to add that to the work in process inventory. And finally, we have to add our manufacturing overhead. And don't worry about how we do this right now. Just I want you to get the process of how we're doing this first. We'll get into manufacturing overhead probably more than you want shortly. So we add all these up, and that will give us our work in process available. So we got to make sure you're adding 3 items into this work in process account. From this, we subtract, we're right back to our beer problem, we subtract our ending inventory, those 6 bottles of beer we have Monday morning, we subtract our ending inventory. That will give us our cost of goods manufactured. That's how we get to cost of goods manufactured. You have to reconcile the raw material and the work in process inventory. We're not done. We need to get cost of goods sold now. Remember, cost of goods manufactured flows out of work in process into finished goods. So let's do that one. The third one we do it again. Finished goods inventory, beginning balance. And our beginning balance was whatever it was at the beginning of the period. To that we add our cost of goods manufactured, which we just figured out. That will give us the total finished goods inventory we have available for sale. From that, we subtract how much beer we have left. I'm going to keep using the beer example. So we subtract our finished goods inventory ending balance, and that will give us our cost of goods sold. And look where this goes. It goes on the income statement. So you can see how raw materials flows into work in process flows into finished goods, then finished goods finally finds its way onto the income statement. Now I'm going to make a very critical point here that I want you to remember, because we're looking at product costs. Okay? When we're dealing with product costs in a manufacturing company, not a single penny of manufacturing costs, not a single penny of them, and remember the 3 manufacturing costs, materials, labor, and overhead, not a single penny of manufacturing costs shows up on the income statement. Let's write that out. Shows up on the income statement. You should be making your notes here. You should be writing this down as well. This is how we learn. Shows up on the income statement until, can you guess how I finish this? Not a single penny of manufacturing costs show up on the income statement until a finished good is sold. When a finished good is sold, we record a sale and the cost of goods sold. But it doesn't show up on the income statement until it's sold. It shows up on the balance sheet. That's why product costs are also called inventoriable costs. So it flows through as purchases, into raw materials, into work in process, into finished goods, then finally it shows up on the income statement as cost of goods sold. So it's inventoried until we sell it.